Returning to our program once again this month is John Fleming, President of Localzo Associates. It's great to see you, John.
Mike, it's great to be here again. Nice to see you again.
According to all reports, the economic recovery is not as robust as many people had hoped. As a result, I suppose that many companies are both cutting back and disposing of some of their lines of business. This has a major impact on financial reporting, doesn't it, John?
Well, Mike, it might be a little more broad than that. While discontinued ops is certainly a continuing issue, it might be more of an issue of asset impairments, where we're looking at not only the disposal of assets, but we're also looking at assets that are losing their value, maybe because of not being used for the purposes intended. Maybe it's because they did shut down a facility and they haven't sold it off, but it's idle, sitting there idle. Or maybe it's just as simple as an office building that's not utilized anywhere near to what it used to be in some years in the past. The guidance in the literature tells us in Topic 360 that if a triggering event takes place to lead you to believe that an asset or a group of assets may be impaired, then you have to perform the asset impairment test. The asset impairment test is a two-part test. One, you predict future cash flows based upon how you intend to use the asset, add them up, total the cash flows. You do not discount them. Then you compare that to the carrying value. If the total cash flows are less than the existing carrying value, it's impaired, then it must be written down to fair value. That's literature. It's been in the guidance for many, many years. So the first issue, I believe, is do we have existing assets that may be impaired? And the triggering event that would cause the asset impairment test is the recession. And it's hard to argue there hasn't been a triggering event given what we see happening throughout the economy and continue to happen throughout the economy. So first issue is I could have assets that I've not sold, I don't intend to sell, but are not generating the cash flow that we had previously anticipated. They may be impaired.
Okay, the first issue is impairment of existing assets. But what about the other issue you mentioned, accounting for these so-called discontinued operations?
If you have a discontinued operation, your presentation of the gain or losses associated with the discontinued operation are placed below operating income on the income statement. So you get a separate presentation that doesn't affect the ongoing recurring results. In this country, we have a current requirement that says if the seller has any continuing involvement in the property transferred, then the assets transferred would not be eligible for discontinued operation treatment. So if the seller financed the deal, if the seller managed the property, if the seller collected rents from a rental facility, that would be continuing involvement. As a result, the presentation could not be as a discontinued operation.